I'm Jason Stipp from Morningstar. Fund flows tell the tale. Investors have been swapping into index funds at the expense of active funds. Should retirees follow suit? I'm joined today with Morningstar's Christine Benz, our Director of Personal Finance, to get her take on the situation. Christine, thanks for joining me.
Jason, it's great to be here.
So we have seen a lot of money flowing into index funds. You presented some pros and cons for retirees who may be considering swapping into index funds. Let's start with the pros. This is a big one for index funds. They are typically very low cost.
That's right. So when you think about active funds, many of them have expense ratios that are in the neighborhood of 1%. When you're thinking about the return potential of your portfolio, as you are transitioning into having a more conservative portfolio, you've got more bonds in that portfolio, its return might be maybe 4% over time. So if you're paying 1% in expenses, you are giving away a fourth of your return. Index funds and exchange-traded funds, by contrast, you can buy for under 10 basis points in many cases. That would be just a 2.5% bite out of your 4% return. So you need to keep that in mind. They can be, low costs can be an especially important advantage in retirement.
Index funds also tend to be tax efficient.
That's right. Broad market equity index funds tend to be more tax efficient than actively managed funds. And that, too, is an important benefit for retirees because many retirees come into retirement with substantial assets in taxable accounts. So being able to reduce the tax collector's cut of your return within those accounts is a really important advantage.
Another benefit of index funds, you say, is that they can often make your life simpler.
That's right. So you can get away with fewer holdings if you have broad market index funds as kind of the core of your portfolio, or maybe the whole of your portfolio. And because index funds track their benchmarks, they don't have active managers, there's less for you to monitor and keep track of on an ongoing basis. You're not having to pay attention to things like manager changes or strategy changes. You know that your index fund is going to be a pretty pure play on whatever market sector it's tracking.
And given that almost by definition index funds are pure plays on an area of the market, if you use index funds, you have much more control over your overall asset allocation.
That's right. It's much easier to see if your portfolio gets out of balance and you need to sort of scale it back into balance. It's easier to see, well, here's where I need to trim to get this thing back into the sort of asset allocation mix that I was targeting.
So a very strong case for index funds, but there are also some things you should consider, some potential downsides. One of them is that not all index funds are cheap.
That's right. There are index funds out there that have expense ratios that are higher than actively managed funds. So just because it's an index fund or an exchange-traded fund doesn't mean that it's a bargain.
In addition, not every niche or nook and cranny of the market is indexed as well as other areas. So there may be some areas of the market that indexing just doesn't perhaps hold up as well as an active approach.
That's right. There are a few areas, not a lot, but a few areas where an active fund may in fact be preferable. One area would be high yield. I think it's interesting that even Vanguard has an actively managed product in this space. It does not have an index-based high yield bond fund. Another area would be potentially the municipal bond space, although I think it's getting a little better. Vanguard's set to roll out a muni bond index fund, but for now, I think investors are better off sticking with the active funds from Vanguard or from Fidelity.
And the other thing to keep in mind when you're investing in an index, that's going to be fully invested in that particular area of the market, regardless of whether it's looking very overvalued or very risky, you're in.
That's right. So the fund has no choice but to track that benchmark. That's a potential disadvantage in very overpriced markets. We saw, for example, with the S&P 500 in the early 2000s, for example, had to just mirror the market's allocation to technology stocks, which of course were very overvalued at that time.
So let's talk about some of the advantages of an active approach. And the first one is related to that last point, is that if you have an active manager and that manager sees an area of the market like tech, deck that looks very unattractive, they can just avoid it.
Right. So some active funds, certainly not all, but some active funds may be paying a little more attention to the downside. You may have active managers who, in an overpriced market, might build cash or avoid that overheating area. That's not something you're going to be able to take advantage of with an index product. The flip side is also true that active fund can back up the truck for some very undervalued market sector. You're not going to be able to get that with an index product. The index product will just mirror the benchmark's allocation.
Of course, active managers don't always get every call right, but certainly there are some active managers that have very good track records over the long term. Another reason to consider active management is that, as you mentioned before, some of the areas of the market have been tougher for index funds, or the indexes are a little bit quirky. You might want to consider active management there.
Right. So we talked about high yield and municipal bonds being arenas where active management is arguably the better way to go. And as you said, there are also some quirky indexes. So a lot of people have been talking and looking at the Barclays Aggregate Index over the past few years. It is heavily reliant on government bonds. Roughly 70% of the index is in government bonds. A lot of people have said, I really don't want to have that heavy government bond exposure. I'd rather be a little bit more diversified across the corporate and mortgage-backed bond sector. Emerging markets equity indexes are also very heavy on China, on the Chinese market. That has been to their disadvantage recently. I was talking to our colleague Patty Wee, the senior analyst who covers passive products. She actually thinks that active management is a better strategy in the emerging market space, specifically because of that heavy China exposure in the index funds.
So as with anything, know what you're holding, whether you're holding it through an index fund or an active fund. On some downsides to active management, they tend to be pricier than index funds.
Absolutely. So those managers and analysts don't work for nothing, that the costs are higher, and we talked about how that can be a big disadvantage as your portfolio's return potential shrinks. You'd want to try to shrink your expense ratio as well.
And compared to index funds, active funds are usually making more moves in and out of securities. That means they can also be not as tax efficient as index funds.
That's right. So for your taxable account, you want to make sure that you are paying attention to tax efficiency, trying to reduce the drag of taxes. Actively managed equity funds will tend to have higher tax cost ratios than if you're just holding a big, broad total market index fund or certainly an exchange traded fund. With bonds, though, I think some people get confused by this. There really is no advantage to holding a bond index fund or ETF from a tax efficiency standpoint. The tax treatment of those income distributions will be identical, and index funds or ETFs don't have any special mechanism to change that.
And also you say some active funds really aren't that active.
Well, that's the thing, and I think that this is probably a leftover effect from the 90s, where we had this tremendous bull market where being anything but fully invested was penalized. So it's really become a convention in the fund industry, for much of the fund industry, that active managers, if they're running an equity fund, for example, that they stay fully invested at all times. Of course, there are some really good examples of funds that do not do this. Some of our favorite funds, so you think of a shop like Yackman, for example, if the market isn't serving up what they think are attractively priced opportunities, they're fine holding cash. But many funds do not have any defensive attributes at all, nor do they purport to. So it's really important, if you're owning an active fund, make sure you understand its strategy. It won't automatically protect you.
FPA, another shop that will really go against the grain and hold cash when they're not seeing opportunities. And lastly, these active funds, especially when they are truly active, they do require some more oversight from a portfolio planning perspective.
Right. So I often say that simplification is really important as you're getting into retirement, that you want to try to reduce your oversight responsibilities. That is something that we all need to be thinking about, but particularly in our later years. If something should happen to us, we don't want to leave our loved ones with a really messy portfolio of lots of moving parts. So it is important to try to skinny down the things that you need to keep track of. I think index funds, by contrast, do reduce those oversight responsibilities on an ongoing basis, and so would tend to be preferable to active funds from that standpoint.
Christine, great food for thought on active versus passive in retirement portfolios. Thanks for joining me.
Thank you, Jason.
For Morningstar, I'm Jason Stipp. Thanks for watching.